OpenAI made $13 billion in 2025 and lost nearly $21 billion doing it. Same company, same year. Now here's the question I want you to sit with for the next few minutes. Is that a problem? Or is that exactly what you'd expect from a company building the most transformative industry infrastructure of the century? Because the answer to that question is also the answer to whether AI is the next Amazon or the next Pets.com. First, let's understand why the losses exist, because it's not mismanagement. Training a frontier AI model requires thousands of GPUs running for months. GPUs require data centers require power, and all of it requires capital that has to be spent before you earn a single dollar. In 2024, OpenAI spent roughly $2.37 for every dollar of revenue. By 2025, they had improved to around $1.60 per dollar earned. The direction is better. The scale is still enormous. And it's not just OpenAI. The four largest technology companies, Amazon, Microsoft, Alphabet, and Meta, are projected to spend a combined approximately $725 billion on AI infrastructure in 2026 alone. That's a 77% increase from the year before. This is the largest infrastructure build-out in corporate history, guys, and it is accelerating. The reason is structural, guys. For companies like OpenAI that rent compute rather than own it, every new user and every new model run is a cost. Revenue grows, but so does the bill. So why are investors still pouring money in? At the time of its IPO filing in June 2026, OpenAI carried a valuation of approximately $852 billion. Anthropic, according to its most recent private funding round in May 2026, was valued at roughly $965 billion, though it's worth noting that a private round valuation, not a traded market cap, and these figures can shift quickly as new information comes in. Neither company is profitable, neither one is. Both are valued near $1 trillion, and the bull case for both is essentially one historical analogy. Amazon, 1999, the company was losing money hand over fist. Analysts questioned whether selling books online could ever generate real margins. 2 years later, the dot-com bubble burst. The NASDAQ fell roughly 78% from peak to trough. Amazon's own stock dropped around 90%. And then Amazon survived and rebuilt and became a pillar of the global economy. The argument is simple, guys. If you are building the infrastructure that the next 20 years run on, the losses are not a warning sign. They're just the cost of entry. There's also a meaningful structural difference from 1999. The companies funding this way, which Microsoft, Amazon, and Google, are already enormously profitable. Their core businesses generate the cash flows that make the AI bet possible. And that's a very different setup from loss-making startups surviving on speculative capital alone. The Amazon story is compelling, but Amazon also had to actually become profitable, and the hype had to become a real business. For the AI thesis to work, 3 things needed to happen. First, the loss ratio has to keep improving. OpenAI went from spending $2.37 per dollar of revenue in 2024 to around $1.60 in 2025. Now, if that trend continues, profitability becomes a question of timing. If it stalls, the story gets harder to defend. Second, the cost of running AI has to keep falling. The cost of AI inference has been declining steadily, and it's driven by better hardware and software optimization. Now, if that continues, each dollar of revenue becomes cheaper to produce. The entire margin structure of the business depends on that. Third, enterprise adoption has to materialize at scale. OpenAI reportedly projects revenue of around $200 billion by 2030. Anthropic's annualized revenue run rate reached approximately $47 billion as of May 2026, a figure that, if sustained, changes the profitability math significantly. These are projections, not guarantees, but the direction of adoption is real. All 3 of these are plausible. None of them are certain. So, Amazon or Pets.com? The honest answer is that the data doesn't tell us yet. The losses are real, the valuations are real, the technology is real, profits are not, at least not yet. What separates the 2 outcomes is not the quality of the technology, it's whether the economic model catches up to the vision before the capital runs out. Amazon did it, Pets.com didn't. That's the only question that matters here. If you found this useful, follow for more. And if you know someone who's watching the AI headlines but hasn't looked at the financials, please send them this.